Thank you, Gwen, and good afternoon, everybody. Thanks for sticking around on Sunday afternoon. It's a good time to update on Orezone. Lots happening. We did a press release last week just sort of outlining some of that. So I'll quickly walk through it. You all know the forward-looking statements. So Burkina, great mining jurisdiction. In fact, last year it was probably one of the top jurisdictions in Africa. IAMGOLD, Semafo and Endeavour knocked it out of the park with their costs and their free cash flow last year. I expect the same this year. And it's been a great place to do business. We have an experienced management team, have been there for quite a number of years, including several of the board members with various other entities in Burkina. So we've been building and operating mines, and we know how to build them, and we know how to operate them, we know how to sell them. We can figure it all out. This is construction ready. We're actually in the middle of what's called the RAP, the Resettlement Action Plan. We move a number of families off to new villages, quite common in Burkina. That's happening right now. We're in the middle of detail engineering and on the Oxide, so we're pretty much moving forward here. A very short payback. I think Gwen said that, and the grades on the oxides in the first 4 years are phenomenal, and we're just literally, first year, we're mining a strip that's 40 meters wide by 20 meters deep by a kilometer long. So it's pretty easy mining with a strip ratio of less than 1 to 1. So the first year is really about 170,000 ounces at all-in sustaining costs of somewhere around 400. And if you want a benchmark on that, just go look at what Endeavour did at Hyundai when they were mining the oxides at the start of the project. It was a cash flow machine, and this will be the same. So we are optimizing the project. We got the oxides out last year. We brought in RCF as a toehold investor. They've been a great investor and partner with us. But we knew there was excellent upside for sulfides. We were doing drilling. We wanted to finish that off on a high-grade zone in the south. We've now got that modelled up, and it's going in together with other several zones, and that will come in year 3. And we think that's really a game changer for us. The oxides, although great cash flow, they tail off in the production towards the latter end of the mine life. And by bringing in the sulfides for minimal capital, it really bumps up the production. And it's, since we put that press release out, the inbound calls from the mid-tier African producers have been quite serious. We haven't entered any data room yet, but likely when we get that towards the finishing post, we will. And as I said, very supportive shareholders, including ourselves. I've got the 2 biggest individual shareholders are in the room, Mike Halverson, the chairman, and myself. And we continue to buy in the market because we see significant value here. We're really focused here on NAV per share, as are our other shareholders, including RCF, Sun Valley, Equinox, etc. So since I joined in 2017, it's really been a turnaround and commitment and turnaround, and we have changed the development strategy. We simplified the flow sheet, made it a project that we can build, very low capex of about 140 million. So we think we can probably get debt in the region of 100 to 120 based on early discussions with banks. We're focused on project scale that we can build. Maybe somebody who would do this had a bit deeper pockets would likely build it a little differently, but not much different than what we're doing. We've delivered on the feasibility study on the oxides. We got RCF in as a supportive shareholder. They took 20% of the company at 19.9. The project enhancements are now underway. We're now covered by 7 equity research analysts, which is quite phenomenal for a company our size. And these go across the board from the big banks right through the boutiques. And we've commenced the project development. So where are we? I'm not too sure I've got a pointer here, do I? I do. So we're right in the middle of Burkina, which is important for a number of reasons. But more importantly, right just beside us is West Africa, and they're now building their project. It will do about 140,000 ounces, more or less. And right beside us is B2, and really it's their Tuega project. It's about 2+ grams. They had a maiden resource. So there's a significant number of ounces, around about 10 million ounces, sitting right in this little 11-kilometer radius. So we think there's a consolidation part to this story as well. Burkina has been in the news, and no point in ignoring that. There has been some tragic incidents there. Mainly things moved across from Mali and are in the border regions. This is the French government map on the hot district. We're sitting right here, and I can tell you, we obviously have good security systems, but we don't see anything. We're 80 kilometers from the capital. We're right beside the main government firing range. We've got one of the major police stations beside us. I was there 2 weeks ago, so we really have not seen anything. And I think the Burkina government is now really doing a pushback, and it's starting to happen. And they were really taken aback by this. It's a very, very peaceful country, so this was news to them when this all happened. So now they're getting a bit more serious about this. I think you'll see things clear up there pretty good in the next 12 months. So the team, we've constructed and been right in on the development of 13 mines. We've done 19 M&A transactions, so we also know how to do that. We've been involved with 10 debt and project financing facilities, and we've raised over $2 billion in equity. And we've operated, between the various management guys, 10 mines, be it in companies where I had 4 mines at one time or 2 mines at one time, or whatever, but we've been involved in the operation or run 10 mines. So this is not a neophyte team here. The project, quite unique. It's a 11-kilometer long shear with 4 main pits along it and several other small satellite pits, with the central plant here and the tailings facility here. This is the water storage. There's a river, seasonal river runs through here. There are about 240,000 ounces sitting there in oxides. They weren't permitted before, but you'll see in the feasibility they will come in. And then down to the south is where we have this new sulfide, high-grade sulfide discovery. So simply from the point of view of moving around, optimization of grade, etc., very simple, because we can operate 5 or 6 pits at once. If it's not as if you're in one pit and you have to mine the pit the way you need to mine it, we can do it sequentially the way we need to do it. And the oxide plant, again, very simple, Lycopodium. I think they've built the last 8 mines in West Africa. There's a common theme with Lycopodium: on time, under budget. And it always happens. And if you just read the press release recently from Endeavour on the Ity mine being done by Lycopodium, it's 20% under budget and 2 months ahead of schedule. And they build them cookie cutter. So when the banks see you've got Lycopodium, they like it. I don't know if I can go back, but very simple. No crushing. End dump straight into a hopper, apron feeder, into a mill. We grind about 20% of it. The other 80% is already at the right size. So no power required for grinding, into a 24-hour leach circuit, into a thickener, and the tailings pond is sitting right there. So it takes about a 500-meter pumping. People think, oh my God, your tailings pond is right beside your plant. Well, it's a little different than Brazil. We do downstream construction. So no upstream construction. It's fully lined. It's a 3-to-1 slope, and we're in a non-seismic zone. So it's a very safe and secure system. We do not have that system where the water goes up against the tailings dam itself, creates a phreatic surface. That doesn't happen here. It's lined. So why do we have such great margins? Oops, I'm doing this again. No pre-strip. Life of mine strip ratio of 1.6. Free dig. No rock or quartz. No crushing required. Low-tech fleet, so we can, for $40,000 a truck, we can haul 30 tons of what is basically sand. No drill and blast. Drill and blast alone is $1 a ton. That's $1 a ton we save. So for $13 million of savings over any other mine, because there's no drill and blast. Shallow pits, 45 meters deep. Low pumping costs out of the pits, low maintenance in the pit bottom itself, minimal mining sustaining capex, no crushing. There's another $3 a ton, maybe $3.50. 20% requires grinding, so only 20% of the feed actually gets ground. Most rock has got a work index of 14 to 18 kilowatt hours per ton. That's the power required to reduce it to the size that you liberate the gold. We're at 2 to 5, way low on the power cost. In fact, it costs more power to turn the mill than it actually does to do the work in the mill. Sort of crazy. So low grinding media, low abrasion. Most rocks 0.3 to 0.4 abrasion. What does abrasion mean? It wears down the parts on the mining equipment, wears down the crushing parts, wears down the pump parts. We're 0.06, an order of magnitude less. So fast leach kinetics, not 48 hours. As general, this is 24 hours. So then again, low cyanide. Our cyanide is 0.2 kgs per ton. Our lime is less than a pound a ton. That's what makes it work. That's what excites people about the project. Right now, we're in the wrap, the relocation. We've just finished the front-end engineering and design. We'll get into the detail engineering in second half of this year. And main construction in 2020, commissioning in the middle half of 2021. We do have these high-grade sulfides. Besides P17 South, which is plus 2 grams, we've got these significant zones of higher grade. The main sulfide is about 1 gram. These are around 1.3 to 1.4. So by adding a small crushing circuit and grinding circuit, we add the extra ounces. And what we're looking at is this. There's the oxides, average depth of 40 meters. You can see the shallow oxides. This is all high-grade sulfides beneath it. This one goes to 220 meters. Our study, when it comes out, will only go to 90. So there's way upside to move forward with that. We think there'll be a 16 to 18-year mine life here. And all we do is this. There's the oxide plant I showed you early on. We put a little crushing and grinding plant beside it, and then add it back into that oxide plant and combine it. We've done all the met test work. The combination of sulfide and oxide has no difference on the leach kinetics. Very clean sulfides, no nasties, straight into the tailings pond, all done. So no extra capital on this end. So for $30 million, we add probably in the region of $100 to $140 million of NAV. And we'll add another 40 to 50,000 ounces a year. That's now what makes it attractive for those mid-tier mining companies. What does it do for this? So when you see it, this was the 4.5 million oxide. This will go to 5.2 now. That's what we're building, likely for the same capex. And this will go to about 170, this to about 160. And then we add the sulfide mill in here. Boom, that will go back up to 160 and tail off to about 120 in year 12. So now you've got a way different production profile. Next steps, update the resource, should come out in about a month. Then the sulfide study in Q2. And then we're in the phase 1 resettlement plan. Detailed engineering will continue on the oxide into construction, and then financing options or whatever else we want to do with the company as we move forward over the next 12 months. Thank you.